You know, right now, there are two completely different stories being told about the American economy. And honestly, they totally contradict each other. One story is all about booming markets, record highs. But the other one, it's about families just trying to keep their heads above water. So how can both of these things be true at the same time? Let's break down this paradox.
So if you just look at the headlines, you think everything is fantastic. I mean, the stock market is hitting all-time highs, but when you peel back that top layer, you find a completely different reality. Personal debt has absolutely exploded to a record-breaking $1.23 trillion. These two numbers, they just don't add up. Something's not right.
And that right there, that's what we're calling the Great Economic Paradox. It's like we're living in two different economies at once. You've got this one, headline-grabbing economy of massive gains, and then you have the other one, the one where most people live, which is a story of debt and just, real everyday struggle. So how is this even possible?
Okay, so let's start with the Wall Street side of this thing. Let's pull back the curtain and really figure out what's driving these record market highs. Is this a sign of a really healthy, broad-based economy, or is it something else entirely?
Well, the answer is kind of shocking and pretty simple. The market's incredible run isn't because everything's doing great. No, it's almost entirely being propped up by a tiny group of mega companies, the ones they call the Magnificent Seven. Get this, they account for almost 80% of all the gains in the S&P 500. So if you take just those 7 companies out of the picture, the rest of the market is basically flat. That means the entire stock market's health is now balancing on the head of a pin, on just 7 companies. That's a huge, unprecedented risk.
And this concentration, it isn't just about which companies. It's also geographic. The whole national economy is basically leaning on just 3 states, California, Texas, and New York. Why? Because that's where all the tech investment that's driving the market is centered. Think about what that means. If this one, very narrow sector starts to have problems in just a couple of places, the entire US economy is in serious trouble.
Okay, so that's the Wall Street illusion. Now let's flip the coin and talk about Main Street. Because over here, the data tells a completely different and much more painful story. If you look away from the stock tickers, you find all this evidence of a silent recession that the big headlines are just completely missing.
The human cost here is just staggering. In the last year, over 2.2 million cars were repossessed. That number is right up there with what we saw during the 2008 financial crisis. And it's not just hitting people with bad credit anymore. We're talking about prime borrowers, people with good credit, who are falling behind. This isn't just a number. It's millions of families losing their ability to get to work, to take their kids to school.
So why is this happening? Well, it's a vicious cycle, a real trap. First, prices for the things you actually need, food, housing, gas, they're just stubbornly high. Second, for most people, wages just haven't kept up. So that leads to step 3. Families are forced to put essentials on their credit cards. We're not talking about vacations, we're talking about groceries. And that's exactly how we end up with a mind-boggling $1.23 to $1.33 trillion in national credit card debt.
Even the job market, which is so often pointed to as a sign of strength, is showing some serious cracks. There's this thing analysts are calling a silent labor recession. What it means is that the government will release these really positive initial job numbers, but then a month or two later, they quietly revise those numbers downward. It's happening consistently. Basically, the data is finally catching up to what so many people are already feeling. The job market is just not as strong as it looks on the surface.
And another key part of the economy, American manufacturing, is also struggling. Despite all the promises to bring it back, manufacturing employment is actually going down. And things like tariffs, well, they've pretty much just ended up being a tax on American consumers and have raised costs for our own manufacturers, which, you guessed it, feeds right back into that whole cycle of debt.
And right here, this is where the two stories, the Wall Street illusion and the Main Street reality, they connect in a really dangerous way. The spectacular rise of the stock market is almost entirely built on excitement around one thing, artificial intelligence. But what happens if all that excitement is just a fragile bubble? This really brings us to the core question, doesn't it? Is all the money pouring into this AI boom based on real, actual, sustained profits, or is it based on something way less stable like pure speculation? Well, critics of this boom are pointing to exactly that problem. They argue that the AI sector is getting these huge valuations based on unproven, speculative expectations, not on real profits that are actually being made. It's like a gold rush where everyone is getting rich selling shovels, but very little gold has actually been found yet. So when you put it all together,
You've got a consumer base that's struggling, a job market that's weakening, and a stock market that's being held up by a speculative bubble. The final warning from all the data becomes crystal clear. The entire system is looking incredibly fragile.
And on top of all that, there's growing pressure from the outside. Around the globe, foreign investors and central banks are slowly but surely starting to move away from the US dollar, partly because of all the global instability. And this just adds yet another layer of risk to an economy that's already under a lot of strain.
Look, this isn't some fringe theory or fear-mongering. Major financial institutions are the ones sounding the alarm. In fact, analysts at the huge bank UBS have put the probability of a US recession at a shocking 93%. That's not a guess. That is a sober, data-driven assessment coming right from the heart of Wall Street itself.
So, this all leads us to one final huge question. What happens when the speculative AI bubble that's holding this whole thing up finally starts to lose air? Because when that moment comes, and it seems like it will, the country is going to face a very difficult and incredibly important choice. And here's the choice. Do we let a necessary and, yes, probably painful, correction happen and let the market actually fix itself? Or do we go down that very familiar road and see another massive corporate bailout where taxpayer money is used to save the very same institutions that fueled all the speculation in the first place? The answer to that question is going to define the American economy for a generation to come.